What if everything you thought you knew about money was wrong? What if the cash in your wallet, the numbers in your bank account, the so-called lifeblood of our economy, was nothing more than an elaborate illusion? We're taught that governments issue money, that central banks manage it for the public good, and that the system is designed for stability and prosperity. But what if I told you that the vast majority of money in existence was not printed by any government, not dug from the ground like gold or silver, but simply typed into being created out of nothing and controlled by private hands? This isn't a conspiracy theory. This is the forgotten history of how money itself was quietly taken out of the hands of nations and placed into the vaults of a small, elite group. A story so enormous, so consequential, that it shapes the price of your morning coffee, the rent you struggle to pay, the cycles of booms and busts, and even the rise and fall of empires. It is the story of power hidden in plain sight, the grand illusion. To uncover how this illusion was built, we must step back in time, long before digital screens and Wall Street skyscrapers, to a world where money was heavy, solid, and tangible. 17th century London. Merchants, nobles, and traders moved wealth around in sacks of gold and silver. This metal wealth was real, but it was also cumbersome and dangerous. Bandits lurked on the roads. Shipments could be lost to storms or pirates. Carrying your fortune was a risk every time you stepped outside. So the wealthy looked for safer options, and they found them in the goldsmiths with craftsmen who worked with precious metals and had strong vaults for storage. Depositing gold with a goldsmith meant safety. In exchange, the depositor received a receipt, a simple slip of paper promising that the bearer could reclaim the gold at any time. At first, these receipts were nothing more than claim checks, but something curious began to happen. People realized it was far easier to trade the receipts than to withdraw the gold. Why carry heavy metal when a piece of paper could do the job? This moment was revolutionary. Those paper receipts began to circulate as money. They weren't coins struck by kings or silver bars pulled from mines. They were promises backed, at least in theory, by real gold. As these slips passed from hand to hand, a subtle transformation occurred. Trust shifted from the metal itself to the paper that represented it. And then came the insight that changed everything. The goldsmiths noticed that only a small percentage of depositors ever came back for their actual gold. Most of the time, the gold just sat in the vaults, untouched. The rest of the economy moved on paper alone. So the goldsmiths asked themselves a dangerous question. If no one is claiming most of this gold, why not issue more receipts than the gold we actually have? As long as people believed the receipts were backed, the system would hold. And in that moment, a new kind of alchemy was born, money created from nothing. This was the seed of what we now call fractional reserve banking. The receipts that should have been tied directly to deposits became tools of credit. The goldsmiths lent out extra receipts to borrowers and charged interest on money that, in reality, did not exist in their vaults. The profits were enormous. The practice spread, and society began to run not on actual wealth, but on promises stacked upon promises. At first, this trick looked harmless. It lubricated trade, it allowed entrepreneurs to borrow capital, it seemed to make the economy more dynamic. But hidden within it was a time bomb. Because if too many people demanded their gold at once, the whole illusion would collapse. That fear, that instability, would haunt every financial system that followed. By the late 17th century, this quiet experiment in money creation collided with the desperate needs of a nation at war. England was bleeding treasure in its long struggle with France. King William III faced empty coffers and no one willing to lend. Traditional credit sources were exhausted, the monarchy's reputation was poor. Yet war demanded funding. Into this crisis stepped a group of wealthy financiers, led by William Paterson. They offered the king a radical solution. Create a corporation, lend the crown over £1 million, and in exchange receive extraordinary privileges. Thus, in 1694, the Bank of England was born. On paper, it was a private company. In practice, it held the keys to the kingdom. The bank lent the government money, received bonds in return, and then used those bonds as the basis to issue new notes, notes that circulated as money. In other words, the debt of the government itself became the foundation of the nation's currency. The more the government borrowed, the more money the bank could create. For the first time in history, the creation of money was formally linked not to gold or silver, but to government IOUs, managed by a private institution. It was an ingenious system. The crown received endless funding for its wars, and the bankers earned endless streams of interest paid by taxpayers. But it also established a pattern that would echo for centuries: money as debt and debt as profit. Across Europe, this model caught fire. Other states saw the power of central banks backed by government promises. To rulers, it solved the eternal problem of funding without direct taxation. To bankers, it was the greatest business ever invented. But to ordinary people, it meant their money was now tied to systems they neither saw nor controlled. The system eventually crossed the Atlantic. The newly founded United States of America faced the same dilemma: how to build a stable currency and finance its debts. Figures like Alexander Hamilton argued for a central bank modeled on England's, while opponents like Thomas Jefferson warned it would enslave the people to private creditors. The first Bank of the United States was born, majority owned by private investors. Its 20-year charter expired, was briefly revived with a second bank, and then killed by Andrew Jackson in a populist revolt against concentrated financial power. For much of the 19th century, the US lived with a chaotic but decentralized banking landscape. Yet elites on both sides of the Atlantic were never content with chaos. They wanted order on their terms. And as history shows, when the system lacks a central power, crises inevitably emerge to justify one. That justification arrived in the early 20th century, with the Panic of 1907. Markets crashed, banks failed, and the economy convulsed. The nation was saved not by the government, but by J.P. Morgan himself, who used his own wealth and influence to corral bankers into a rescue package. The message to the public was clear: America needed a lender of last resort. But behind closed doors, bankers saw opportunity. 3 years later, on Jekyll Island, Georgia, the blueprint for the Federal Reserve was drafted in secret. Politicians and financiers worked hand in hand, crafting legislation that gave the appearance of a public utility while securing private control. In 1913, just before Christmas, the Federal Reserve Act was signed into law. America now had its own central bank, a hybrid system with a federal board, but regional banks owned by private institutions. The illusion was complete. Money creation was no longer in the hands of the people's representatives, but managed through a mechanism designed by and for bankers. And from that point forward, the cycles of debt, credit, boom, and bust would accelerate, each one drawing ordinary citizens deeper into a system they barely understood. This is only the beginning. Because once you understand how money shifted from gold to paper, from public to private, the next question is inevitable. What happens when even paper itself is abandoned? When the last anchor is cut and money becomes nothing but digits on a screen? That moment arrived in 1971, when Richard Nixon closed the gold window and ended the convertibility of dollars into gold. From then on, money became purely fiat, declared valuable by government, created without limit by central banks and commercial lenders. It was the final transformation, and its consequences are still unfolding today. The story is long, twisting, and filled with shocks. But to grasp why our world feels increasingly unstable, unequal, and fragile, you must see how this illusion grew from the vaults of goldsmiths to the screens of central bankers. Because once you see the trick, you can never unsee it. And so the real question is not simply, what is money, but who controls it? From the moment Nixon cut the dollar's last tie to gold in 1971, the world entered a new era, an era where money was no longer a claim on something real, but a pure abstraction. It was valued by decree, enforced by government fiat, and managed through the private machinery of banks. At first, the change seemed almost invisible. Life went on. Dollars still bought groceries, paid rent, and settled debts. But beneath the surface, the very foundation of the financial system had shifted. Freed from the discipline of gold, governments and banks discovered an intoxicating freedom. They could expand credit, issue new bonds, and print currency without restraint. The United States, as the issuer of the world's reserve currency, enjoyed a privilege like no other. Other nations had to earn or borrow dollars to participate in global trade, but the US could simply create them. This arrangement became known as the petrodollar system, where oil and other key commodities were priced in dollars, ensuring perpetual demand for the currency. The illusion had not only been preserved, it had been globalized, but with freedom came temptation. Governments now ran deficits with little immediate consequence. Wars could be financed without raising taxes, expansive social programs could be sustained on borrowed money, and every dollar of borrowing meant new profits for the banks, who created money by lending it. The system became an engine of debt. Debt fueled consumption. Consumption fueled growth. Growth fueled optimism. But beneath the optimism, something dangerous was brewing. Because when money is created as debt, then by definition, the system must always expand. Every loan requires repayment with interest. That interest can only be paid if more money is created, which means more debt must be issued. It is a treadmill that never stops. Step off, and the system collapses. This treadmill produced a series of booms and busts, each one more violent than the last. The 1,980 seconds brought the savings and loan crisis. The 1,990 seconds saw the dot-com bubble, where easy credit chased internet dreams until the fantasy burst. The 2000s unleashed the housing bubble, fueled by mortgage-backed securities and reckless lending. Each collapse left devastation in its wake, lost jobs, ruined savings, shattered lives, and yet, each time, the same medicine was prescribed. More credit, more money creation, more intervention by central banks. The cycle reached its breaking point in 2008. The collapse of Lehman Brothers, the implosion of mortgage derivatives, and the freezing of global credit markets nearly toppled the entire financial order. For a moment, the illusion faltered. The public glimpsed the truth that the system was fragile, constructed on promises and leverage, and that even the largest institutions could fall. Panic spread. Ordinary people lost homes, jobs, and retirement funds. But the bankers who had engineered the disaster were not punished. They were saved. The Federal Reserve stepped in with an extraordinary response. It created trillions of dollars electronically, what they called quantitative easing, and used it to buy toxic assets and government bonds. On the surface, this stabilized the system. Banks survived, markets recovered, but underneath, the pattern deepened. Private losses had been socialized. The illusion had been reinforced, not dismantled. Between 2008 and the present, central banks around the world repeated this playbook again and again. Every crisis, from the European debt meltdown to the COVID-19 pandemic, was met with a flood of newly created money. Balance sheets ballooned. Interest rates plunged towards zero, and in some countries, even below zero. Trillions were conjured into existence, not by labor, not by production, but by keystrokes. The result? An unprecedented concentration of wealth. Asset prices, stocks, bonds, real estate soared, enriching those who already owned them. Meanwhile, wages stagnated, costs of living rose, and inequality widened to levels unseen since the Gilded Age. The illusion, while invisible, has very real consequences. It divides societies. It destabilizes democracies. It erodes trust. And yet, the system continues because it must. Without constant expansion of debt, the engine seizes. Without constant creation of new money, the illusion unravels. This is why crises are never wasted. They are opportunities to tighten the grip, to expand central control, and to push the boundaries of what money itself can be. Which brings us to today, and to the next chapter of this story, the rise of central bank digital currencies. For centuries, the illusion has rested on paper promises and private ledgers. But what happens when money becomes a line of code, issued directly from a central bank into a citizen's digital wallet. Imagine a world where every transaction is visible to authorities, where money can be programmed to expire if not spent, where purchases can be blocked or encouraged at the touch of a button. To some, this is efficiency. To others, it is the ultimate weapon of control. We stand at a crossroads. The goldsmith's trick has evolved into a planetary system, sustained by debt, hidden in plain sight, and now poised for its most radical transformation yet. The question is no longer what is money, but who will decide what money becomes. Because once money itself is programmable, once every dollar is traceable and every account is under centralized authority, the illusion will not just guide our economies, it will define our freedoms. And so, as we look at the centuries-long journey from sacks of gold to paper receipts, from private banks to central banks, from fiat dollars to digital tokens, we are forced to confront the deepest truth of all. Money is not just an economic tool. It is power. It is control. And the grand illusion has always been about who wields it. Power. That is the thread running through this entire story. The illusion of money has never simply been about currency or banking or economics. It has always been about power. Who holds it, who wields it, and who pays the price when things collapse. To see this clearly, we must look not only at history, but also at the repeating patterns that bind the past to our present. Consider the panic of 1907. A crisis erupts, confidence collapses, and ordinary people suffer. In the aftermath, the very bankers who helped create the instability present a solution: centralized money creation under a Federal Reserve System. Fast forward a century to 2008, once again, a crisis erupts. Banks gamble recklessly, the system buckles, and ordinary people lose homes and jobs. And once again, the solution is presented by the same institutions that caused the collapse. Trillions of dollars in bailouts, funded not by productivity or savings, but by debt creation. The cycle is clear: crisis, rescue, consolidation. The numbers tell the story better than any rhetoric. In 2008, the US Federal Reserve's balance sheet stood under $1 trillion. Today, it hovers in the range of 6 to 7 trillion, after peaking near 9. Global debt in 2000 was around $80 trillion. Today, it exceeds 330 trillion, over 3 times the size of the global economy. This is not growth. It is leverage stacked on leverage, credit built on credit, all sustained by the illusion that more money can always be created to paper over the cracks. But illusions cannot last forever. History shows that every fiat money system eventually collapses under its own weight. Rome debased its silver coins until their value evaporated. Revolutionary France's paper assignats ended in hyperinflation and ruin. Weimar Germany printed marks until wheelbarrows of notes could barely buy bread. Each time, leaders promised stability. Each time, the temptation to print was too great. Each time, the system imploded. Why should our era be different? The United States dollar has reigned supreme for decades, but already the cracks are visible. Nations weary of dollar dominance are exploring alternatives. Inflation has surged to levels not seen in generations. And central banks, trapped between the need to stimulate growth and the fear of runaway prices, are walking a tightrope with no safety net. So what happens if the illusion breaks? What if confidence, the only true backing for modern money, shatters? The consequences would be seismic. Markets would convulse. Savings would evaporate. Governments would scramble to maintain order. And in the chaos, new systems would emerge. Some predict a world of decentralized cryptocurrencies. Others see the rise of centralized digital currencies controlled by states. Both possibilities are already unfolding. But let's step back and look at the deeper pattern. Each transformation in money has come with a trade-off. Gold brought weight and security, but also inflexibility. Paper brought convenience and credit, but also fragility. Fiat brought freedom to governments and central banks, but also limitless temptation and debt. Digital currencies promise speed and transparency, but threaten surveillance and control. At every stage, the illusion adapts, but the core question remains: who benefits? For centuries, the benefits have flowed upward to those who create money, not those who use it. The goldsmiths of London became wealthy, lending out receipts. The bankers of the 18th and 19th centuries profited from government debts. The financiers of the 20th century leveraged the Federal Reserve System to expand their reach. And today, the largest institutions on Wall Street reap billions, while ordinary citizens wrestle with rising prices and stagnant wages. The illusion enriches the few and burdens the many, and yet the system persists because people believe in it. As long as the public accepts paper, plastic, or pixels as money, the game continues. As long as workers trade their labor for digits in an account, the machine runs. Belief sustains the illusion, which brings us to the most important part of this story: the choices that lie ahead. Because illusions are powerful, but they are not permanent. They can be broken, rewritten, or replaced. And if history is any guide, the breaking point always comes when trust finally erodes. The question is, are we nearing that breaking point, or are we sleepwalking into the next phase, where money is not just a medium of exchange, but a tool of direct control over human behavior? To answer, we must distill this centuries-long history into three simple truths. First, money is not what we think it is. It is not neutral. It is not a simple tool. It is a technology of power, shaped by those who control its creation. Second, the system's design guarantees instability. A structure that requires perpetual debt growth cannot remain balanced forever. Crises are not accidents, they are the predictable outcome of the model. Third, every fiat system in history has failed. Our global fiat experiment is the largest ever attempted. It will also end. The only unknowns are how and when and what comes next. And that leads to the final warning. If the next system is built on central bank digital currencies, programmable, trackable, and controlled, then the grand illusion may become something more dangerous. Not just an economic trick, but a cage. A system where money itself can be used to dictate behavior, silence dissent, and shape society according to the will of the powerful. The story of money is the story of control. And the grand illusion is not merely historical, it is alive, shaping our lives every day. The question for us is whether we continue to live inside it blindly, or whether we finally choose to see the trick for what it is. Because once you see it, you cannot unsee it. And once you understand it, you have a choice: to accept the illusion or to reclaim the power that was quietly taken from us centuries ago. So, the story of money is not just ancient history, it is unfolding around us right now. Every headline about inflation, every debate about interest rates, every whisper about central bank digital currencies is another chapter in this ongoing saga. The illusion still lives, still shapes the boundaries of our lives, still decides who prospers and who struggles. But illusions are fragile things. They depend on belief, and belief can shatter overnight. Think about the world today. In the past few years, trillions of dollars were created to keep economies afloat during the pandemic. Prices surged, supply chains buckled, and families felt the pinch at the grocery store, the gas station, and the rent check. Ordinary people sensed something was wrong. They worked harder, but their money seemed to buy less. The illusion, once invisible, began to flicker. At the same time, new contenders have entered the stage. Cryptocurrencies promise to return power to the people, money without intermediaries, beyond the reach of central banks. They attracted believers, dreamers, and speculators. Yet they too face volatility, manipulation, and the looming hand of regulation. The battle between centralized control and decentralized freedom is no longer theoretical. It is happening in real time. And looming over it all is the specter of central bank digital currencies. Governments argue they will modernize payments, reduce fraud, and increase efficiency. Critics warn they could usher in an era of unprecedented surveillance and control. Imagine a future where your every purchase is tracked, where savings can be penalized with negative interest, where your access to money can be switched off with a keystroke, To some, that is progress. To others, it is the final lock on the cage. So where does that leave us? After centuries of gold and paper, of debt and credit, of crises and rescues, what lessons remain? 3 stand out above all others. First, money is not neutral. It is not just a tool for exchange. It is a system of power, designed and controlled by those who issue it. To understand money is to understand control. Second, the illusion requires endless growth. Debt must always expand, crises must always be managed with more credit, and the treadmill must always turn. That is why instability is not a bug, it is the system's most predictable feature. Third, no fiat system lasts forever. Rome, France, Weimar, Zimbabwe, all believed they could print their way out of trouble. All discovered the same fate. Our global fiat experiment is simply larger, more sophisticated, and more digital. But it too will end. The only question is how and what will replace it. And so, the warning. If we enter a future where central bank digital currencies become the foundation of money itself, the illusion may become something far more dangerous. Not just a sleight of hand, but a total system of surveillance and control. The power once hidden in vaults and balance sheets could become a daily presence in our lives, shaping what we can buy, when we can save, and how we can live. But there is also hope. History shows that every collapse creates an opening for something new. People are asking deeper questions about money than ever before. Alternative systems, from digital currencies to local barter, are being explored. Awareness is growing. And awareness is the first step to change. So the choice before us is stark. We can accept the grand illusion, surrendering ever more control to those who profit from it, or we can begin to reclaim money as a public good, a tool of exchange and trust that serves society rather than enslaves it. The illusion has lasted for centuries, but illusions do not endure forever. They survive only as long as people believe in them. And now, you know the trick. The question is, what will you do with it? Will you step deeper into the illusion? Or will you pull back the curtain and demand something better? The choice, for now, is still ours. So, ask yourself, if money is the greatest story ever told, do you want to remain just another character in someone else's script? Or will you finally start writing your own? Because the grand illusion will not end on its own. It ends when we choose to see it. It ends when we act. And if you've stayed with me through this journey, if you've felt the weight of history and the urgency of the present, then you know this truth. The most powerful question you can ask today is not what is money, but who should it serve? That answer is not written yet. It's waiting for us to decide. The curtain has been lifted, the illusion is exposed, the rest is up to you.